Welcome back to the Laser Fund Masterclass. My name is Emron Andrew. This is my father, Douglas Andrew, a couple of the co-authors of the Laser Fund. In this episode, we're going to jump into Chapter 2. So if you're following along with us, it's on page 17 of Section 1 of the Laser Fund. And so Chapter 2, titled Escape the Tax Trap. Dad, why don't you take a minute here and with this first introduction of this chapter, give us a little bit of an introduction.
Well, in the book, we talk about how, as a family, we love to go to Alaska fishing, and I've been up there several times. You've been there with me, and we'll oftentimes go out for a great day of fishing, whether it's for salmon or grayling or trout, halibut out there in the Glacier Bay. But we'll come back. And I remember one time when I was fishing down at what harbor was it that we were in, where it was so beautiful and picturesque. But all of a sudden, I heard something, and grizzly bears were right behind us. Now, you don't want to get between a mama grizzly and a cub. But oftentimes, there would be trappers in the past that would trap wild game. And we always see that. In fact, that was the icon I used in my first book, Missed Fortune, when I talked about the tax trap, was that trap that had the big sharp teeth in. And I think those have been, deemed not humane anymore. But I want you to visualize the kind of traps that would trap wild game. And I know that's a little bit gruesome, but this is the kind of trap that people get into at retirement when they thought, as they were just socking away money in traditional IRAs and 401ks, for example, or even pension and profit sharing plans, that when they hit retirement, they would be in a lower tax bracket. And all of a sudden, they're trapped and they don't know what to do. And they're going, wait a minute, what happened? This premise this didn't play out like I thought. So we're going to talk about how to escape that tax trap or get out of it if you're close to being trapped with a bunch of taxes that we think are unnecessary.
I think you use the right word there anyway, gruesome. I mean, I don't know how many times I've talked to a retiree, and the retiree did not even contemplate or suspect that their taxes would be what they were when they hit retirement. The taxes were gruesome. The taxes are very gruesome when they hit that retirement.
Many times when people would either cash in or redeem or take money or borrow out of an IRA or 401k, and then they couldn't pay it back, and all of a sudden it becomes a taxable event. Or you sell a piece of property and you spend all the money, and the next, April 15th, your accountant goes, you owe a capital gain tax of this, and people go, I don't have it. And this is why the IRS got sick and tired of trying to collect all this money that people weren't expecting to have to pay. And so they began to mandate that you had to withhold it. They wanted the money so that they didn't have to go chasing after people for this tax. And so, this whole thing, I often say on the radio, when people retire, and I use an example of the school teachers that came to me, and they had saved in the state's 401k, and they had TSAs, tax sheltered annuities, and also 403bs. And they thought they were going to be in a lower bracket, and they hit retirement, and they sort of made the mistake of thinking, okay, with our defined benefit pension, and if you don't know what that is, that's where the entity, in this case the state, knows that, okay, we've got to have a defined benefit when you retire, and it's usually based on a formula. A lot of states have a formula that you'll get paid 2% if you're a school teacher for every year of service you taught school. So if you taught school for 30 years, 2% times 30 is 60%. So let's say the school teacher was making $5,000 a month the last few years they were retiring. 60% of $5,000 a month is $3,000 a month. And of course, most of us go, I can't get by on 60% of what I was earning. So they sock away money into 401ks, 403bs, and TSAs, and they have this nest egg, and it grows to $250,000 or $500,000. And so they hit retirement, and they go, whoa. They've got Social Security now showing up here, and now they've got their defined benefit pension, and their deductions are no longer what they used to be. And now they have this nest egg, and they have to start pulling money out of that thing by the time they're 70 and a half. And they find themselves in as high or higher tax bracket as they were in when they were earning, and they never saw that coming.
Yeah, you mentioned something very important there. As you look on, as you're on page 17 right there, you see that tax trap. But then right at the bottom of the second to last paragraph right here, deduction, reduction. I can't tell you how many times, you can even see people when they hit retirement. I've seen people when they hit retirement and their income goes down in retirement, and yet their taxes went up. And it's because, again, if you don't prepare appropriately, what's happening is you hit retirement and a bigger percentage of your income is exposed to taxes because of that deduction reduction. When we hit retirement, we lose, typically most Americans will lose their 3 largest tax deductions when they hit their retirement years. What are they? Well, number one, you lose your mortgage deduction. Most of us have our homes finally paid down or paid off, so we lose the mortgage deduction. Number two, our children. Our children are finally grown up. I kind of joke sometimes they've grown up, but maybe they haven't moved out. But even if they haven't moved out, you don't get the deduction anymore. You still may maintain the cost, but you no longer get the deduction. So we lose the children. The last one, the one that most of us don't usually think about, because most people will answer mortgage, children. The third one is all of the contributions you're all currently making to things like IRAs and 401ks, especially right before retirement. Just before retirement, you might be socking away 10, 15, 20, 25% of your income trying to prepare for retirement to make that last mad dash, and everything you're socking away is a tax write-off. And so you've got a lower tax exposure, but all of a sudden you hit retirement. Are you still saving that money? No. When you hit retirement, you're no longer saving money. You're doing what? You're pulling that money out and exposing it to taxes. So the number one mistake most people make is just that. They get caught in that trap and discovering that when they hit retirement, all of the money they have has much larger tax exposure because they've lost all their deductions.
The old premise, just tax defer. You put in pre-tax money, okay? When you put money into an IRA, it's tax deductible. A 401k, it's pre-tax dollars. It doesn't matter how you look at it. The premise was put in pre-tax dollars. That's more money, and more money in the front end is going to grow to a bigger sum down the road.
Right.
Because you're going to be in a lower bracket then. And again,
everybody hears that.
That has not been true or axiomatic for over 25 years. And it would drive me crazy. And it did take, as I mentioned in the first episode, Chapter 1, the financial services industry until just about 3 years ago to finally admit maybe that wasn't the best advice. And that's actually what precipitated in 1997 the Roth. Harry Roth said, people are getting smarter. They're realizing that they're not in a lower tax bracket. It'd be better to get the taxes over and done with on the front end. And so and the government was hard up for money. So it wasn't for you so much as it was for them because they needed some money. And when you convert to a Roth, you trigger the tax. And so Roths were a step in the right direction, but there's still so many strings attached that we've outlined in Chapter 1 and we'll talk about again. But this is why I use the metaphor of people were going down the highway trying to achieve their destination of financial independence, retirement, and they didn't realize they had one foot on the gas pedal. They were deferring, putting in money into these tax-deferred accounts, but the other foot was on the brake pedal, killing their deductions. The mortgage, as you've said, the children, the contributions, and Congress keeps raising taxes. They have this huge appetite. And if you're a business owner, you lose all those deductions too. So it's a real hit for business owners.
Absolutely. In fact, it's interesting because the government really has 3 real main ways to increase taxes on us. Number one, the easiest way is to manipulate the tax rate, raise and lower. That's the one everybody pays attention to. But there's two other ways that they do this as well. Besides just raising or lowering the tax rate, they can also eliminate deductions. For example, we have the Trump tax code that was passed, but in order to get that Trump tax code passed, they had to eliminate deductions. And the easiest question I always ask is, in order to get that passed, they had to eliminate deductions to get the lower tax rate. But then when they turn around and raise taxes in the future, do you really think they're going to give us those deductions back? The answer, of course, is this is the game they've been playing for decades. They go ahead and manipulate one and take away so they can come back and raise. They did this in our good state of Utah. Yeah. I'd look at that. We back in 2008, we had Governor Huntsman came in and ran on the premise of lowering our tax rate here in the state of Utah from 7 down to 5. Well, before that was a 7% marginal rate, and he lowered it down to 5. But to lower it down to 5, he went to a fixed rate, which is not bad. That's not necessarily the bad thing there. But in order to go from 7 down to 5, the big thing that he did is he also eliminated any and all deductions in the state of Utah. Now, after that passed and went through, everybody's taxes did not go down. In fact, almost everybody across the board, it doesn't matter whether you were wealthy or whether you were poor, your taxes went up. So taxes went up because of that, because of the deductions. Now the funny thing is many years later, almost a decade later, his predecessor is now talking about, hey, maybe we should raise taxes back up to where they once were, 5 back up to 7. Is he talking about moving it back to 7 as a marginal rate? No, moving it to a 7% flat tax. And are we going to get any of our deductions back? Absolutely not.
And you probably meant his successor.
Sorry, not his predecessor, his successor. Now, moving into the next section here, on page 18, procrastinating and partnerships. I'll cover a little bit on the procrastinating and maybe turn over the partnerships to you.
Go ahead.
So, procrastinating. The funny thing is when we look at your traditional financial planning, mostly centers all around tax defer, right? IRAs, 401ks, tax defer, defer. Everybody always tells you to defer. Talk to a CPA, defer. In fact, you go into your CPA on April 15th and think before April 15th trying to file your taxes saying, is there any way for me to pay less in taxes? Well, really the only thing he can do is what? He can try to kick the can down the road by saying, hey, have you maxed out all your contributions to IRAs and 401ks? That's a way to save taxes. And I argue, did you really save any taxes? No, you didn't save any taxes. You what? You postponed or procrastinated those taxes. In fact, what does defer mean? Defer means to put off till later, which is also the definition of procrastinating. And the universe has taught me over and over again that when I procrastinate, particularly procrastinate a problem, does it all just go away? No. It typically what? It gets worse. It compounds and gets worse. And that's exactly what millions and millions of Americans are experiencing as they're retiring. This tax trap, this tax problem was much bigger than they were told or ever led to believe when they hit those retirement years.
If the accountant, and I know they're well-meaning, but if they would have said on April 15th, would you like to save a little bit in taxes right now and procrastinate and put it off and compound it and delay the inevitable and to something, even a bigger tax liability down the road? Would you like to option for that? If they worded it that way. But the problem is too many of these tax advisors are only looking at the moment, the present, not the big picture. And I've always liked to look at the big picture. Hey, and we'll talk about this throughout this book, that you make decisions, you choose vehicles, you choose strategies and investments that will generate the most at the time in life that you're going to need it the most. And instead of just the deduction right now, why don't we look at the best strategy overall?
Absolutely. I mean, you really look at it, you can summarize it even with saying, what's better? Prevention or curing? The old saying, an ounce of prevention is worth a pound of cure. If you keep on postponing your taxes, deferring and procrastinating your taxes, you're creating a problem that you must now cure later in your retirement years. And it becomes very, very costly. If you will simply prevent the problem up front, you can save tens of thousands, if not hundreds of thousands of dollars in taxes. And that is exactly what we're talking about here. That's the impact. We can't get into it real deep right there, but that is the true impact. When we proactively approach our taxes, we can significantly reduce the problem in the future and really cure the problem, or really prevent the problem rather than trying to cure the problem.
In fact, on page 19, I use a little analogy that I a lot of times have fun with when I'm teaching a live audience.
Meaning it's a problem? You mean you're creating a problem? What's the problem?
Okay. I'll say, okay, we're going to go into a business venture, a partnership. And here's the deal. You're going to do all the work in this business, okay? And I'm your partner, and I'm a close partner. In fact, I'm your Uncle Sam. Okay. So Uncle Sam, I'm your partner, and here's the deal. You're going to do all the work, and you cannot liquidate or sell that business prematurely before I want you to without a huge, a 10% penalty. And you'll work hard and build this business to this value. And at the precise time that I want, this time frame, you will sell the business. And I get 27% of it, or I get a third of it. But I do reserve the right that if I feel more hard up than you, that I can raise my percentage up to 50 or 60%. But I get to make that decision and choice. And if you put off selling the business and giving me my share, my lien I have on your business, I will penalize you 50% on top of what you owe me for the business. And people go, what? I go, would you go into business with me? No, what kind of a partner is that? And I go, I just described an IRA or 401k to you, because who's the partner on an IRA or 401k, Em?
Oh, it is the government. It's interesting. As you went through there, I started thinking to myself, well, wait a minute. So we got to this. What were you contributing to the partnership? I never saw any contribution to the. I was doing all the work. I was putting in all the money. I was doing everything, and then you just simply get your share, huh? Yeah. But that's the fact of the matter. I hope you see and understand what an IRA or 401k really is. It's not a sole proprietorship. It is a partnership, and your partner is Uncle Sam or the government. Now here comes down to the big problem. If you ask any attorney, any business consultant, if you had to choose between two roles in getting into a business partnership, which of these two roles would you choose? Would you choose ownership or would you choose control? And every consultant and every attorney will tell you choose control. Because then you can control everything. Or you control the money, you control the distributions, you control it. Now let me ask you the key question. If you have an IRA or 401k, who controls the split of ownership inside of your IRA or 401k? Yeah, it's not you, it's the government. And they can change their ownership any day they want by simply what? All they have to do is raise or lower taxes. And the funny thing is, you look at that and say, well, we don't need to worry too much about that, do we? We understand our partner, the government has our best interest at heart, do they not? And this is where you've got to reclaim control and ownership of your own future. And that's what we get into in the whole strategy of the Laser Fund, is you regaining that choice and control. Because then if I can have ownership and control, now I can have my cake and eat it too.
And it's like we say on page 19, we're not entirely disparaging IRAs or 401ks.
No.
They may have their place as a part for retirement planning. At retirement planning, I'm going to talk about here in just a few minutes, but I often ask my audiences, would you prefer that I be honest or gentle? Okay? And they say honest. Okay, honestly, I have never owned an IRA or 401k, never will. I've never owned a Roth IRA or 401k, never will, because of what I know to be better, and Phil knocks the socks off of those with all the flexibility, is what you're going to learn here is the laser fund. But those of you who are listening and learning right now may have money, maybe a substantial amount of money in an IRA or 401k, and you're beginning to realize that this trap is closing. So we want to address how we can help cure that or free you or escape the trap, and that's why this chapter is titled that. I think it would be important to sort of explain the difference between marginal and effective tax.
Absolutely, because especially if you're ever looking at trying to rebalance yourself, if you're so top heavy, and again, like Doug mentioned there, it's not that an IRA or 401k is the worst, you've made a mistake. No, it's just that if that's where all of your money is when you hit retirement, you're going to be very lopsided tax planning wise. You're going to have too much money exposed to taxes. So a lot of times it's about what? It's about finding the right balance. But as you go through the strategies that we are going to teach inside of the Laser Fund, you want to understand how to proactively tax plan, and to do that, you need to understand taxes, understand marginal tax brackets even versus effective tax brackets. Simply put, an effective tax bracket is nothing more or less than the total taxes you pay divided into your gross income. It's a great FYI number, but it doesn't do you anything for your actual planning. Because again, when you actually look at planning, when you're actually going to do proactive planning and try to get your taxes over and done with, because one of the first steps in a strategic rollout is to get the money out and get the taxes over and done with. Yeah, we're going to pay it, but it's not about not trying to pay taxes. It's about what? It's about paying the least amount of taxes that we're required to pay, rather than going out blindly and getting stuck with paying the greatest amount by simply making the wrong choice. You can make the same account, make the right choice, you'll pay this much in taxes. Make the wrong choice and you'll pay this much in taxes. And it's just a level of knowledge. Now to do that, marginal tax rates, right? So marginal tax rate is simply the tax rate you pay on the last dollars you report to the IRS. And, and we'll get into a little bit more with charts and stuff like that, but just simply put, effective tax rate is the taxes you pay divided into your gross income. We don't use that, it's just a great FYI number. Marginal tax rate is the tax rate you paid on the last dollar you reported to the IRS, and that is the tax rate we're going to use when we look at strategically rolling out money out of things like IRAs and 401ks.
In fact, what you mentioned a moment ago, the government giveth and the government taketh away. I'm a red-blooded American. I think we should all pay our fair share of taxes. And you could actually look at American history, and based upon who was controlling the executive branch and the legislative branch, why certain tax laws have been passed. And we're going to teach a lot of these tax laws that have been passed. And there's two basic philosophies, because it's not really a political agenda here, but it's understanding that one political philosophy, generally speaking, says, well, let's have more and more government programs, and oftentimes the solution is let's raise tax revenue by raising taxes. The other philosophy is let's have less government programs. Let's have school teachers and police officers and firemen, but let's put more of it back to the private sector, and any tax revenue we need, let's raise the revenue that's being taxed. And so we see historical tax laws passed based upon those two basic philosophies. But for example, President Reagan, he was a Republican, and it took until his second term in 1986 to pass what is called the 1986 Tax Reform Act. And the Trump tax changes were the biggest single tax law changes since the Reagan ones in 1986. But based on what Imran just shared with you, when President Reagan passed the 1986 Tax Reform Act, the marginal rate, I think at the time, was like 70% for the wealthy people. And during World War II, I think it got to 94% for those making over $1 million back then. But it was 70%, and Reagan took that down to a federal rate of 28%. There was a little bubble of 33 until you never paid more than 28% of your gross income. So he lowered the marginal rate down to 28, but he got rid of a lot of deductions back then.
That's right.
So the effective tax that Americans paid went from 13% up to 18%, even though the marginal rate was dropped down. So this is why it's important to understand. And as you begin to learn with these charts that we'll go through, you calculate how much room in the next tax threshold. There might be 50 or 60,000 of room between one threshold to another, and you'll want to make decisions based upon the marginal tax rate. Is it worth paying a little bit extra in tax to get them over and done with rather than postponing, procrastinating to the future, especially if we've got signals that the market is on the verge of a correction or a crash or something like that?
That's right. So what happens if we don't? Just stay the course. Stay the course in your IRA or 401k, and everybody else is doing it. So if everybody else is doing it, it can't be that bad, right? Well, let's look at it. Page 20. If we go to page 20 here, we've got this section and this chart that let's go through here. So because many Americans have, your Social Security as a base income, and maybe even a small pension as part of your base income, when you go to pull money out of an IRA or 401k, most of the time money out of an IRA or 401k is on top of all that income. So that money is going to be taxed at 22%, 25%, 27%. And so we're going to use, again, between federal and state. I know many of you might be paying more like 30 or 40%. But we're going to keep it, we're going to stay conservative and just say 27%. So in this chart right here, what we're looking at is a IRA or 401k, or an example of somebody socking away money in an IRA or 401k and allowing it to grow until it's worth $1 million. They retire once it's worth $1 million, and they want to start generating, income from it. So the biggest fear, what is the biggest fear when people retire? The number one fear amongst retirees is what? Running out of money, right? I mean, and so, so what is the calculation, and what does that fear stem from? You may not know the math, but your gut tells you something's wrong here. So if we go to our chart down below, you've got that $1 million, and we are going to, right here, let's go to that paragraph above, going back to our $1 million, as you see in figure 2.1, if you take $137,000 to $150,000 a year. Now, why am I taking out $137,000? I don't need $137,000.
It's like I said in chapter 1. If you go in there and you just pull out 100 because that's all you need, you're going to owe 27% of that, 27 grand, to Uncle Sam and the governor wherever you live, if you live in 41 out of 50 states that has a state income tax. And you got to go back for another 27, and then you have to go back for another 9 after that. And so, well, how much do you need to withdraw first? Well, between 137 to 150 grand, depending on your tax rate, to net 100,000.
That's right. So that's exactly what that chart is showing you. If you go down, maybe make a little note right there on your little chart here with the 137,000 annual withdrawal, and maybe write a little note there that says net after tax 100,000.
Yep.
Okay, so that's all. In order to, you need $100,000 out of your IRA 401k. Well, to get 100,000, you've got to pull out 137,000 if your marginal tax bracket is 27%. And so we pay the 27% in taxes between federal and state, and you're then finally going to net $100,000. Now, folks, if you've got $1 million earning 10%, you might think, oh, I could spend $100,000 a year and never run out of money. Well, you could take out $100,000. You can't spend $100,000. If you're thinking just simply, I've got $1 million earning 10% a year, and if I pull out 100 grand, I'll never run out of money. But if you need $100,000, remember, you got to pull out 137,000 to net 100. So now if you pull out $137,000 and you're earning 10% a year in interest, you're going to slowly deplete your account. Slowly or quickly? You look at that chart. How long does it take us to run out? You go there and it takes us a measly 13 and a half, 14 years between 13 to 14 years, you will be out of money. Now, the second biggest problem we have in our country and our society is that what? People are living longer than ever before. You know, it used to be that when people hit retirement at age 65 and 66, you know, they had maybe a 3 to 5 year retirement before they passed away. People would pass away only 5 years into retirement. Now people are having a beautiful, their golden years are now 15, 20, 30 years.
Oh, yeah.
I mean, if you're looking at a 30-year retirement going from age 65 to age 95, you're gonna have half of those years living in poverty. And that's exactly what this chart is showing you, that typically, if you try to maintain your lifestyle, in fact, that's the mere fact. When you look at most people when they retire, the number one thing people have to do, if they don't run out of money, because they have not properly planned, especially their taxes, is they have to lower their lifestyle. They have to downsize and lower their lifestyle in order to not run out of money. If you want to maintain your lifestyle, well, you better start proactively tax planning now, not waiting till later.
Which is critical because I think there's two things that are certain. Okay, your current tax bracket is likely the lowest bracket you will ever be in, and your money will never be worth more than it is today because inflation is going to also take the value down. And so if the Trump tax cuts expire and we just go back, that's going to take a 22 back up to a 25. From what I understand, if Hillary Clinton had been elected, she was going to go back up to the 28 before Bush cut it back after 2001. So if it goes back up again, I remember many clients in California. California has the highest state tax rate. Many of them were paying between 33 up to 37 up to 39%. Notice this chart is based upon 27%. If you were paying 33%, you'd have to pull out $150,000 to net 100, which is 50% more. So remember this: in a 33% bracket, you have to withdraw 50% more. $150,000, pay a third, 33% of 150 to net 100, and this actually would run out in 11 years.
That's right. Now it's kind of funny though. You know, you asked the question. Right there on page 21, you know, what goes up ain't coming down. What are we talking about? We're talking about taxes. You know, what is the glaring evidence that tells us that taxes are not going to come back down?
Well, we have a government that is addicted to spending, irresponsible government spending and the printing of money and so forth. You just look at the long term. You know, it doesn't matter where I speak throughout America. When I ask audiences, how many of you out there think that in the future, generally speaking, taxes are going to be lower? And nothing but crickets. Okay? How many think they're going to be the same? And some raise their hands, but I think, how many think they're going to be higher? And a sea of hands goes up. And I go, then why, if you believe taxes are going to be higher, are you postponing, procrastinating, and compounding your IRA 401k account to some future perceived unknown advantage to withdraw your money down the road when you're all convinced taxes are higher? And they all go, well, I don't know, what's better? We want to show you what's better, but I just want to share with you, sometimes this book is written left brain, right brain. We're in section 1, which is a lot of charts and graphs and logic, left brain. Then you have a right brain, which is how you feel, and this is your emotion and how your heart feels about it, okay? Well, I found that in counseling a lot of my clients through over 45 years, there were some times that I would say, you know what, you ought to get some money out of this IRA 401k, get the taxes over and done with. And we'd go up in the marginal rate. Let's say, I remember when the marginal rate was 28%, and the next marginal bracket was 31. It was 3% more. Mm-hmm. Okay, and I would say you could actually take out another $57,000. Well, I don't need the money. I said, well, I know. Well, let's get it out, get the taxes over with, and put into the laser fund, tax free from now on. And they would go to their accountant, and the accountant would go, who is advising you? They just raised your tax bracket. I went, I didn't raise your tax bracket to 31%, retroactive back to $1.
Right.
It was on the last 57,000, and that was $1,750. Well, you forced me into a higher bracket. I said it's an extra $1,700, and they said no, I don't want to pay an extra $3. I said okay. Well, there was another reason why I told them, but they forgot, and so they left their money in their IRA 401k in the market, and they lost over 40%.
Yeah.
They came back begging to pay $1,700 in taxes. Instead of losing 40%, it was an extra 3%, only on the last 57,000. So you want to make decisions both logically and emotionally, right brain, left brain, but when you start getting emotion in there, oh, I don't want to pay any more tax, that has cost people thousands of dollars because they weren't looking at it logically also. You know, I've always hated the word retire because it means put out of use. Okay? I don't want to be put out of use. I'll never retire. So let me just say this. When did that come about in the Industrial Revolution when they had factories and workers? When they retired worn out equipment and put it out of use, okay, they decided to retire people and put them out of use. And as you mentioned, Emran, when people were put out of use, because it used to be people would work in the fields and the farm till they died, okay? The life expectancy for an average American was 7 years, and for government workers was only 6 years. For a military retiree, when they were put out of use, they felt like they'd lost everything. It was 5 years. And so the whole Social Security system was designed in that era to never have to pay out Social Security benefits for more than an average of 7 years, and they were done. Now, see, baby boomer couples, one of you will make it to age 90, 95, and healthcare costs are running up. So we've got some serious problems of people running out of money because of this old premise that we've been talking about. So we want to help you redefine yourself in retirement and make sure you don't outlive your money. And that's what this book is going to help you understand how to do.
Yep. And so to not frighten you, as we're moving on here to the next section, obviously some of the frightening numbers is our national debt, well north of $20 trillion. Our unfunded liabilities, Social Security and Medicare, both escalating. Total unfunded liabilities is going well north of $100 trillion. One of the craziest things I always look at is how much is a trillion. It's just unfathomable. And Social Security, if you go straight to SSA.gov, and it will tell you Medicare Part A is the first thing that's going to go bankrupt. It goes insolvent in 2026. Social Security goes insolvent in 2033. Oh, by the way, every year they bring that up and they say, oh, whoops, we mistakenly calculated that wrong, and they move it up another year. So I don't even know if those 2 years, or those are probably the longest those will go before they hit insolvency. They could even go sooner than that.
In fact, if the government stopped withholding FICA and Medicare from people's paychecks, the earners, for a year, it'd be, I think, less than a year. They estimate about 9 months they would be broke. They are relying on withdrawing money from current workforce, which is a smaller workforce than the retiring baby boomer workforce. So we're in trouble.
We are. It's a well-known fact. In order to cover all this going up, they've got two ways to do it. They can raise taxes and they can print more money. Which one are they going to do? Both. Okay, they're going to print more money, causing more inflation. And they can't do just one. The problem is so large, you can't print enough. If you print enough money to cover all this, you're going to make the dollar worthless. And so you can't just print all the money you need. You're going to have to also raise taxes. And, like Doug mentioned, you mentioned there the highest tax rate we've seen. Right now, the highest tax rate you can pay in the federal government is 37%. The current highest rate you can pay this year in 2019, 2020, is going to be 37%. The highest you've ever been able to pay in our country before, 94%. That rate has been as high as 94%. It's averaged 55%. So if we're right now at 37, they're arguing that we're below average. So there's many arguments that will show that frankly, it's just simply put, taxes are going up. And are you going to wait until they go up and pay your taxes? Or are you going to pay them at today's lower rates and be exempt from tomorrow's higher rates?
I could go on and on about Social Security, and that's not what this is about, but don't make Social Security the basis of your retirement, and anything else is a bonus. Frankly, your Social Security maybe should be just the bonus if you receive it. Unfortunately, because it's such a delicate topic of so many people who have paid faithfully into the system, that there's not a politician around that wants to talk about abolishing it or getting rid of it without some kind of a solution. And so they like to sweep it under the rug. It's a delicate subject. It is called an entitlement. And I go, wait a minute, entitlement? When they actually withheld that from me for my entire working career, that is what I deserve. It's not an entitlement program. But anyway, we are going to see a lot of turmoil as people begin to realize that they need to rely more and more on taking ownership for their future and not rely just on the Social Security. So let's talk about what we feel is one of the best solutions, Emran. I think the metaphor that we've used for years is the farmer and the seed. Do you want me to explain it? Or?
Absolutely. No,
Yeah.
it's one of the easiest ways to really summarize this.
I have often said, if you were a farmer and you had the choice of buying your seed in the springtime, let's say, and you didn't have to pay tax on the price of the seed when you bought it. So you bought your seed, there was no tax. And so you planted it, you irrigated, you cultivated, you worked hard, and then in the fall of life, I'm talking about, now you harvest. And you agree to pay tax on what you sell your harvest for. Now, that is a traditional IRA or 401k. You get a tax break on the seed money, what you contribute, and you agree to pay tax when you harvest it in retirement. And that sounded pretty good with the old premise, because you'll be in a lower bracket. And of course, that is not true, and it hasn't been true for over 25 years. So that is no longer axiomatic for people, you're going to be in a lower bracket. In fact, it's usually not true if you accumulated any type of a respectable retirement nest egg. So I would rather pay tax on the seed and enjoy the harvest without tax. Now, you may be thinking I'm talking about a Roth. Yeah, a Roth is a step in the right direction. As I mentioned, in 1997, when the government was so hard up for money, Senator Harry Roth said, hey, I've got an idea and you can name it after me. And the Roth IRA says, you know what, people are getting smarter and realizing it's better to pay tax on the seed money and then enjoy the harvest without tax. The government needed a huge windfall. And by doing this, allowing people to roll money over into a Roth, it triggered the tax. And so it was actually more for them than it was for us. I'm not saying a Roth isn't a good idea. But as we mentioned in Chapter 1, a Roth has basically two advantages. You take after-tax money, you pay tax on the seed, but it accumulates tax-free. You can access it tax-free. The Laser Fund has those two benefits, and they've been around for over 100 years, as we'll explain in the Internal Revenue Code. But there's three other benefits the Laser Fund has. You don't have these strings attached. You can put in during a banner year a few $100,000 if you've designed it to accommodate that. If I put money in and I have an emergency, I can access money with maybe an electronic funds transfer or a phone call without IRS penalties. Even 4 days later, I had one lady put in a whole bunch of money. She put in $200,000 and pulled out $120,000 4 days later. If that was a Roth, you can't do that. And the Laser Fund, if I were to die tomorrow in an accident, every million right now at my age would blossom to about 2.5 million. There's not a Roth around that'll do that. So why would I own a Roth when the Laser Fund, what many CPAs and tax attorneys call the rich man's Roth, when the Laser Fund has all the benefits of a Roth and three more, and that's why I've never owned a Roth and never will, because of what the Laser Fund can do. So what else do you have to add to that?
No, I think it allows you to, it brings back a quote you mentioned in the first chapter. Blessed are the flexible, for they shall not be bent out of shape. Some years, you're going to want to make sure, even in a laser fund, you're setting it up and you're wanting to max out what you can put in each and every year. And then those banner years when you have more, again, like Doug mentioned, the problem with the Roth is that once you max out a Roth, it's not like you can open up another Roth. You can't open up a second or third Roth in the same year and max those ones out too. It's a cumulative max. Versus a laser fund, if you're hitting your maximum in a given year, all you do is what? You open up another account. There's no limitation to how many of these accounts you can have opened or open up new ones. And so the ability to have that flexibility makes all the difference in the world when you're looking at 20, 30, 40 years, because one of the only constants in life is change. Life changes.
Yeah. Emran, you mentioned the difference between prevention. An ounce of prevention is worth a pound of cure. So, in 45 years as a financial strategist and retirement planning specialist, if I were a physician, I probably spent more time curing diseases. Now, see, the word disease means not at ease, dis-ease. And we usually think of that in terms of your physical health. But I am talking about financial dis-ease. People are not at ease because they think they're going to outlive their money. They have a tax disease. Oh, wow, I'm only netting this. I'm having to pull out this much to net this. And so I've had to cure a lot of those diseases. I mean, I've always loved preventing it, but sometimes people, they just followed the herd. And so they hit 59 and a half. They hit 65 or even 70, and they would come to me and go, I'm in this tax trap. How do I get out? How do I escape the tax trap? Hence the title of this chapter. And so one of the things that I would do to cure their tax disease, we'll talk about a lot, and it's what we mentioned before, a strategic rollout. And again, it's not a rollover. See, a rollover is going like from a 401k into an IRA, and you're continuing to defer. And many times people get duped into doing RMDs, required minimum distributions, stringing or stretching out. And we developed this software years ago that basically would show people the darkness of the night if they took out the RMDs and strung it out over both life expectancies, and they were flabbergasted. I remember one couple, they were both school teachers, and our software showed that they would, by stringing it out, pay about $250,000 in taxes if Congress never raised tax. And they went, huh? That's how much we have in there right now. Right. Because they didn't realize the $250,000 they had in there, if they kept stringing it out and they kept growing it tax deferred, they would end up paying $250,000. And I said, so what if we got it out and the taxes over and done with sooner than later? And they went, what? And they were 60, and their accountant was saying, oh, just keep doing RMDs, just defer. You don't even have to start touching this till you're 70 and a half. Well, what we did is we got it out over a 5-year period, and the tax bill went down to about $12,500 a year over 5 years. So instead of paying $250,000 by stringing it out, they only paid $60,000. And we were able to do a few other things for them to even lower that tax bill more, but that's a strategic rollout. And when they got all done, oh my heavens, we basically saved them a couple of $100,000 of unnecessary tax. And it's not just them. There's a lot of other stories in the flip side of the book that you can read. I'm thinking of 2 other examples. One fellow, he hit 70 and a half. And when he came in here, his wife had just passed away. And his accountant said, oh, you're 70 and a half. You got to start taking out minimum distributions or you're going to pay 50% penalty. Now, he had $600,000, and he didn't really need the money. He had a bunch of rental properties and so forth. And so the advisors said, your $600,000 has dropped down to under $360,000 twice, because it was that decade from 2000 to 2010. And he said, so I just want you to do 4%, the 4% rule. What's 4% of 600,000? $24,000. He pulls out $24,000. He's paying a third. His tax bill was a third, $8,000 in tax. He's netting $16,000.
Ouch.
And I thought, this is pathetic. He goes, yeah, this is horrible. A $600,000 nest egg is only generating $16,000 to buy gas and groceries. I said, let's do a rollout. Long story short, we were able to transfer out $150,000 a year over a 5-year period. Now, if you do the math, 5 years times 150 is 750. What? He only had 600 to start with. Because of our plan, he was actually able to earn, I think, an average of about 8.25% during that 5-year period. So as he got it out, we used some strategies. Now, let's just look at this. If he took out $750,000 over a 5-year period, $150 a year, and he paid a third in tax, so $150 and you net $100. So he pays $150,000 in tax. His accountant was like, "What are you doing?" So what did he end up netting into the laser fund in that scenario? $500.
Right.
But you know, his laser fund has been averaging between 8 to 10%. Now let's say 8. 8% on 500,000 is what?
You got a good solid 40,000 coming out.
40,000 taxable or tax-free?
That's the beauty. I mean, that is the beauty. That's the beautiful picture. It's tax-free.
40,000 tax-free compared to 16,000. How much more is 40,000 than 16,000? We do this all the time. Even some years where he's earned 10%, it's been incredible. And so, folks, you can dramatically increase your net spendable income, not just a little bit. Many times it's double or triple by doing a strategic rollout, getting the taxes over and done with sooner than later, like these folks did. Reposition it into something tax-free from now on. But you know what? If he dies now, he'll leave behind $1.2 million tax-free to his heirs. If he died with his IRAs, he'd leave behind $600,000. How much better is $1.2 million than $600,000? It's double if he dies. Right. It doesn't matter whether he lives or dies. It's better. You'll read another story of a husband and wife that when they came to us, it looked like they were going to owe $2.4 million in taxes. They had socked away a lot of money. Now, we couldn't save all of that, but we saved them about $1.2 million, and they set up what we call a family bank to help their posterity. The point is this, Em. It doesn't matter if you're Republican or Democrat. When I show people, here's where the government puts our tax dollars, but I don't say percentages. I just say, here's the basic categories, people, that the government spends our tax dollars on. If you had your choice voluntarily, what percent would you allocate to this category, this category, this category, this category? And it never comes out to the percent that the government is allocating our tax dollars. So it's not a political thing. It's just, well, so if you could redirect, if you had the choice of redirecting otherwise payable tax, where would you put it? And it's not where the government's doing it. So I'm saying, how did we get here? You take ownership and you can redirect otherwise payable taxes to causes you support. And I think you can do that better than, frankly, the government can. And so that's why we like to cure tax disease. So as we wrap up here at retirement,
it's a good notion. I mean, you think about it, at retirement. You've often said that, and I think it's a powerful idea or principle. You know, oftentimes the things that you do to plan for retirement are not the same things you should be doing at or in retirement. If you want your money to last as longer than you do, you need to change up your strategy. And I think a lot of this drives to some of the examples you gave there, which is also, I think, a good example of another metaphor you often use, you know, a battery versus a generator. You know, I think that's exactly what that is, and exactly what that does when you look at your strategy. Don't choose investments based upon what they're going to grow to. You choose accounts based upon what they're going to generate in the time of life that they need them the most.
You know, so many financial advisors, well-meaning, try to charge up a retirement battery, so to speak, and they are trying to hope that that battery won't go dead before you do, that it won't run out of money. There's three big dangers that are shorting out most people's retirement batteries that we've been talking about here. Number one is taxes. People just get shocked because of this trap. And 27%, up to a third, up to some people nearly 40% goes out the window in tax. The second is inflation, because as government prints more and more money, the cost of living will double every maybe 7 to 10 years, which means the purchasing power of the dollar is cut in half. So even if you think, oh, I'll tighten my belt and I can get by on 50,000, well, that means in 7 to 10 years you're going to need 100,000 to buy the same gallons of gas and loaves of bread or haircuts that you could have bought 10 years earlier for 50,000. And so that's what drains it dry. And the third is this market volatility, because when you retire, most firms, most broker-dealers do not ever project cash flow or payout because they don't know what that is. And so at retirement planning is totally different than maybe what you did for retirement. And that's why when people would come to me, let's say they really saved and they had enough resources that maybe with 40,000 of Social Security, and they had another 160,000 a year they were anticipating from their IRAs and 401ks, maybe their real estate or whatever, because on page 26, you might have 4 different sources of income. You might have investment income, which would be IRAs, 401ks, maybe in the market, okay? At retirement, you don't want to have, in my opinion, more than about 30%, at max 50% of your money in yet to be taxed IRAs or 401ks in the market, okay? People might have some non-owner occupied rental income real estate. That's okay. I don't like being a landlord, but if you don't mind doing that, or you have a management company, but that is a bucket or a resource.
Right.
Some people like guaranteed income, and anywhere from 0 to 80% could come from guaranteed income, could be Social Security or a defined benefit pension if you're a school teacher. But some people would like to know that if they ran out of money, they wouldn't run out of income, and there's solutions for that. But my favorite is the tax-free income. And so what I would do is at retirement, I would look at people and I'd say, you've got 200,000, but guess what? 100% of it is showing up on your 1040 tax return. And so over a 5-year period doing a strategic rollout, I would maybe get as much as 60% of that off their tax return. Now, you're going to learn the IRS knows they're receiving that money, but they know it's tax-free and it's been grandfathered as a sacred cow for over a century. So what did we do for them? We changed their taxable income on their tax return from 200,000 down to maybe 80,000. They still have the same 200, but we saved them 40,000 of tax. If one of them lives to age 90, that was an extra 25 years times 40,000 of tax savings. That is $1 million. What could you do with an extra $1 million by planning at retirement, something different to help you redirect otherwise payable taxes? Now, folks, taxes are actually an asset. That was chapter 2 of my second book. And people go, what? Yeah, I mean, taxes. We pay taxes because we have highways, we have police, we have school teachers. But see, what a lot of CPAs and tax attorneys forget within 2 years after they start their practice is that you can redirect otherwise payable taxes to causes you support, and you'll do more for this great country than just rolling over and paying more and more in tax. By you taking ownership and putting your assets into a secure laser fund, the reason why it's tax advantaged, as you're going to learn, is because if I died, my wife, a widow, orphans are not going to rely on the government. I've taken ownership to take care if I live too long, if I die too soon. I want to take ownership, and I take pressure off of the government to do that, and that's why it's a sacred cow. And so when you can redirect otherwise payable tax, taxes are an asset, but when we take ownership and control. When was the last time you washed a rental car, Emran?
Never.
People don't wash rental cars. They wash their own car. The secret to American wealth has always been in ownership, deeds, titles, and articles of incorporation. When you take ownership of your retirement in the best strategies, these aren't tax loopholes. These are bona fide, well-proven, well-tried, over 100 years, where this empowers you and it blesses this country, because you're taking pressure off of relying on the government to take care of you because you outlived your money. And so that's really fair tax. Is when we say unnecessary tax, we're not anti-tax. What we're talking about is, why would you pay? I've never met anybody that would pay more than they feel is necessary. Even a lot of these liberal people who say, oh no, more and more tax, but when it comes down to their tax returns, they never pay more than they absolutely have to. So sort of summarize the takeaways.
Yeah, so chapter 2, Escape the Tax Trap. On the page 27, let's go through the 5 takeaways that we want to make sure you get there and really actually look at the key words, the key power words that you want to remember and take into long-term memory here. Number 1, postponing or deferring. So if you're postponing or deferring your taxes, that's more like procrastinating. Remember, if you procrastinate, so right there, procrastinating. If you procrastinate your taxes, that's just compounding the problem. It never makes it better. Procrastination is never the correct answer. Number 2, you look at this and understand that an IRA or 401k is not a sole proprietorship. Uncle Sam is your partner, and if you really look at that, Uncle Sam is a selfish partner. You know, choice and control. If you had the ability there, I wrote in my side run right here, control. Do you have control over this partner, over your money and your partnership, or does the government have that control? And what are you going to do to make sure you regain that control? Number 3, with the rising national debt of over $20 trillion, unfunded liabilities, I go 20 trillion, unfunded liabilities over 100 trillion, and out of control government spending, it is more likely that taxes are going to be what? They're going to be higher. They're going to increase over time. And so it doesn't make any sense. I don't see any argument that makes sense to go ahead and avoid paying today's lower rates only to put yourself into the trap of paying tomorrow's higher rates. Number 4, Americans would do well to consider that it is advantageous to pay taxes on the seed rather than on the harvest. Does that make any sense? It does not make any sense to go ahead and pay the tax to avoid the tax on the seed, right? It doesn't make any sense to avoid taxes on seed to pay taxes on your entire harvest. It makes complete sense to pay the tax on the price of the seed so that you can enjoy your harvest tax-free.
And I would say, again, the seed money is the contribution phase. We're going to talk about in future chapters the contribution versus the distribution phase, which is the harvest.
And then finally, the last point, the last key takeaway here, to avoid outliving your money during retirement. The number 1 fear amongst retirees is running out of money. It is important that you plan your at-retirement tax bill. If you don't, you're going to just simply be subject to everything else around you. You won't be able to control your environment. Your environment will control you. And that is the biggest mistake you can make financially. Don't allow your environment to control you, but you control your financial environment, allowing you to have a much greater net spendable retirement income. Well, that is the best way to kind of summarize and talk about the tax trap and how to escape it. Chapter 3, when you join us there, you will be jumping in, going into some more of the successful strategies. Chapter 3, what successful folks know. We look forward to seeing you in that next episode.